welcome to the Bullpen. In the Bullpen today, we have Mr. Alex Rosado, Professional Programs Assistant at Alexander Hamilton Society, Research Fellow for Horizon Info Consultant with the Young Voices also contributor there. Fascinating. Good to have you on the program, sir. How are you?
I'm doing well, Dr. Richey. Thank you so much for having me.
Thank you for being on the show. We're going to chop it up about the Dodd-Frank Act, which was passed in 2010. You are of the mindset, I believe, that it should be a deregulated dynamic. I don't want to presume what you know, believe about it holistically. So I will allow you the opportunity to provide your point of view, and then I will opine.
Certainly. Well, in an age of economic innovation within America, there are unfortunately some regulations and acts that are holding us back. And one of them just so happens to be the Dodd-Frank Act that you just mentioned. And this is on a variety of fronts as well. And all of these come back to community banking. You're seeing a lot of bank closures within the United States. The most recent one just happening last month in Illinois with Pulaski Savings Bank. You saw it in 2023 that America saw the highest amount of bank closings since the 2008 recession. And you also saw that the number of community banks within America, those with less than $10 billion worth of assets, shrank by about 14% between Dodd-Frank's passage in 2010 and 2014. Now, these are going to affect communities and local lenders the most. They rely on these institutions for a customized and tailored service. And unfortunately, they can't get that if they're being hammered by compliance costs and other economic relations that make it harder to survive and thrive.
Let's talk about the Dodd-Frank Act in a more holistic dynamic, because obviously there are some dynamics inside of it that, in my opinion, are quite beneficial. There may not be too much daylight between you and I on this. I've said for many years that the Dodd-Frank Act has stopped the ability to, let's say, a Black-owned bank wanting to become a community bank. The regulations and the authorities that are required, the hurdles you have to jump over, are basically so significant that it becomes an ineffective process for somebody to engage. And so I get that part. But would you argue that every single aspect of the Dodd-Frank Act should be eliminated? For example, the consumer protection modalities that are included, or the state expansion programs that are included. Would you also throw those out in the act or in the reformation of it?
Well, I think in regards to reformation, you need to look at each piece individually. And especially when they relate to community banks, you see that action has been taken previously with legislation that has been passed by both the House and Senate in a bipartisan fashion. You saw that back in 2018 with an act called the Economic Growth, Regulatory Relief, and Consumer Protection Act. This was pioneered under the Trump administration first time around. And what it did is reduce the regulatory burden for a lot of these small banks and consumers. It increased lending flexibility, and it also lowered compliance costs. And a lot of Democrats ended up joining up on this act. You saw that it passed the House by a margin of about 260 to 159. 33 Democrats supported it there. You saw it in the Senate as well, where 17 Democrats supported it. So truly, this is something that people are united across the aisle about. When it comes to economic reformation, truly this is something that America as a holistic society can benefit from.
Let me get some specifics. So one thing the Dodd-Frank Act did is it enhanced state authority to create consumer protections based on the deceptive practices that had become habitual in that state. That's one element that was enhanced through the Dodd-Frank Act. Another one was oversight of the actual institution. The financial institution had this requirement to report information, which also included information that could be seen as or deemed as discriminatory. Specific consumer protections included mortgage lending, credit reporting, meaning a person could get a free credit report. They didn't have to pay for this. And also it eliminated unfair practices by establishing a general ban on deceptive, abusive, and unfair practices. I would imagine that you don't want those elements taken out of whatever the new branding is for the reformation, right?
Well, some of what you referred to happens to fall within the Durbin Amendment that was also passed within Dodd-Frank. And unfortunately, this was a way of government overreach that slapped price controls on fees that banks and credit unions can charge retailers to process debit card purchases. Now, what ended up happening with that? You saw that banks and credit unions across the country couldn't recover most of those costs. So, how did they make up for it? They charged the consumers. And that led to reduced benefits, a lot less tailorized services, and higher fees at these local institutions. And that drew out a lot of business that they usually would have gotten. And it also resulted in some of the poorest consumers and investors within the economy dropping out of the banking system entirely. In fact, you saw a study from George Mason University back in 2014 saying that about 1 million Americans lost access to the banking system, becoming what they call unbanked. And unfortunately, due to these regulations, you're seeing that this is becoming more of a common trend. And now about a third of counties nationwide don't have community banks at all.
Yeah, I think we're back to the community banking dynamic, which I agree with you in. But what consumer protections would you keep? Or what
Well, I would
consumer
definitely
protections would you enhance? Or do you want consumer protections to be gone away with all the way?
Well, I think with consumer protection comes with innovation as well. And we need more resources and monetary wealth within the pockets and hands of consumers that would do so. For example, having not just community banks, but also just certain institutions have programs and services that will allow young, hungry entrepreneurs to enter the
Yeah.
market.
But sir,
That happens.
I'm specifically, and hear my question specifically. Many of the dynamics associated with banking came because of deceptive practices from the financial institutions themselves. They were the bad actors who routinely were not held accountable for the deceptive practices, abusive practices, and the usury practices they implemented on individuals that were typically poor. So when I pose that question to you, I'm asking you specifically, are there any of the consumer protections that you actually do agree with to ensure that the industry as a whole does not run amok again on the consumer? Because every industry worth industry status has regulation that at least is common sense. A medical doctor is regulated, a psychiatrist is regulated, a veterinarian is regulated. So what regulation would the financial industry have to the consumer?
Certainly, price gouging would not be good across the board. I don't think any government actor would want to deliberately raise prices in order to profit from them. And meanwhile, gatekeeping consumers from certain products, services, industries that would enhance their quality of life. Because especially for low income communities, you see that economic mobilization is a social upbringing. And particularly, this affects low income communities the most. You're seeing that, particularly with 1/3 of Hispanics and African Americans, they don't meet the underwriting requirements that are really being generalized by a lot of these poor economic policies. And because of that, they can't
Yeah, but
obtain
but
mortgages.
once again, you're dealing with, and I get that part, and we're back to the point that we actually agree on, that you have to make it easier for community banks to, one, develop, and two, thrive. So we agree on that point. But let's go to another specific point. One of the dynamics under the Dodd-Frank Act, and I'm no fan of the act, I'm simply a fan of people. And so I see some of the elements here that help people. So I want to talk about those. The expanded state authority portion of the act, which gives the state attorney general the authority to hold the financial institution accountable if they are in violation of deceptive or abusive practices. Would you get rid of that portion? Would you not want there to be, even if it's not a regulatory system, at least you have a law enforcement system that can enforce the law for the local citizens who may have been taken advantage of?
Well, I think certainly it would be great to have more accountability within the system as well. But you also have to make sure that that power doesn't go unchecked or goes rogue. And especially with a lot of government overreach, you get to see that once you have a certain policy in place, it becomes not innovative, but expansive. And those are two very different
But you're
concepts.
arguing a hypothetical at this point, and that hypothetical could be utilized to offset any type of proposed program or regulatory institution. My question is, as it stands now, would you be in support of the state remaining within their authoritative control to prosecute bad actors in the financial institution industry? That's it. Would you be okay with that?
I would prefer the states take charge over matters that are in their own backyard rather than the federal government doing so, just because of the devolution of
So
powers.
you agree. So the expanded state authority came by way of the Dodd-Frank Act.
I would say yes, and it came about in some of the most worst ways possible.
Okay. All right. So we quasi agree.
I would, yes, draw that line in the sand as well.
All right. So let me ask you about the creation of the Consumer Financial Protection Bureau, which came out of that. This act established a dedicated agency to focus on consumer protections at large. Would you want to have that reformed, or do you want to get rid of that holistically as well?
Well, from personal experience, just talking about this, and there's an article that I'm writing up talking about this as well. Specifically, the Consumer Financial Protection Bureau wasn't that useful of an organization, and you saw that within the first 20 days of the second Trump administration. You saw that Rohit Chopra, the former head of the CFPB, just got ousted. Jonathan McKernan just took his place last week. You also saw the CFPB headquarters in DC get shut down recently as well. About 100 bureaucrats were fired. And you have to note that none of these officials were actually elected. They were government appointees, and they were filled for a certain agenda. And you have to wonder what exactly that was. Now, of course, there will be debate and discussion about that as well. But the notion that a lot of these institutions that were brought about with Dodd-Frank, saying that we need to make sure that these bank systems aren't too big to fail, well, 2023 will tell you otherwise. So
Well, I agree that the regulators, you had the wrong individuals in place. You also had an implementation standard that was not to the standard of consumer protection. That's different than if the act itself, the Consumer Protection Act itself, should that be reformed to make sure it's done properly. There's one dynamic when you argue implementation. There's another if you argue that the institutional entity itself should not exist. So which one are you arguing? Is it implementation, or are you saying that the Protection Bureau should not be in place?
I think in a way, the Protection Bureau and its responsibilities should be devolved to other assets within the government, or potentially going back to communities, state governments as well.
Well, let's talk about who then. If that's your proposed solution, that's fine. I can rock with that. Who's going to do your stress test? Who's going to do risk mitigation? Like what agency in the federal government would take on the responsibility of the Bureau?
Well, I think this would be a joint venture between potentially the Commerce Department and also the Treasury Department as well, because they're the ones who deal with most financial repercussions and try and have those stress tests in place, like you saw in the aftermath of 2008 as well.
All right. Listen, we agree on a couple of things and disagree on most, but it's, you're a smart guy, robust conversation. I appreciate your time on Indisputable.
Thank you so much, Doctor. Thank you so much.
Thank you. All right.